Welcome back. Let's continue the how to create the cash flow statements for the long-term financial planning. Once we created the balance sheet and income statement, creating statement of cash flows is very simple. Based on this indirect method, we'll reconcile net income and add back depreciation and get all the current asset and liability changes, and then we got the cash flow from operations. And then we will get this change in gross fixed asset. Why not the net fixed asset? Because depreciation is considered here. And then we get this cash flow from financing for AFN and each year or not. And then we got the net changes in cash, the summing all this cash flow from financing, investing, and operating. And then beginning cash of the last year balance, and then we get the ending balance, and then we'll check this ending balance is the same as the ending balance on the balance sheet. Okay, here net income must be reconciled, and then we link. Then the depreciation here we calculate it, then remove negative, then we collect the positive. Change in accounts receivable should be starting from the last balance and the current balance, so that we get the negative if it has been increased. Then let's drag. The change in inventory. Change in inventory also asset account. We start from the last balance and then current balance. And then let's just drag. Then next, the change in accounts payable. Accounts payable is the liability. When we increase the liability, then cash up, right? And then from the current year minus the last year. And then we got this positive balance. The same way, accrued liability also, we calculate this changes as an increase in cash. So we sum those all up. And then we have the cash flow from operations all the way up years. And then we'll compare this as the net income is different from operations, because net income is considered the accrued accounting, and also the depreciation, which is non-cash flow. And change in gross fixed asset, we already have these changes in net. We need to calculate here changes in gross asset. Here we go, right? So once the asset increase, that means cash out. Then we got this cash balance, the cash flow from gross the fixed asset. Now next, if you don't have any other transaction, then that is the cash flow from investing, right? Just give me a second if we get the right one. Oh, this is my mistake. You must calculate this changes for the gross fixed asset, as I explained earlier. Then it has been increased because we already considered here the depreciation, right? Here we collect gross fixed asset. If gross fixed asset increased, that means cash out. Now, if we don't have any other asset, then that is the cash flow from investment. Change in a bank loan. We assume that there's no changes, right? So we can just drag. And then change in a new common stock. Here we have increased, that means cash up, right? But it's not actual cash in, because that cash is covered, right? To invest it is bigger total asset than total liability and equity. So Then we found the AFN has been increased between the 2022 and 2023. Changes in common stock doesn't change, right? And then cash flow from financing, sum those two up. Oops. Let's use the sum in this order. And then we have all this cash flow from financing. And once we get this cash flow from operations, investment, and financing, let's just sum all those up. Then 650. Then we got all this net changes in cash from all the activities. Now, the beginning cash amount is the ending balance of the cash, ending balance of cash of the prior year, the required cash and excess cash. Then let's drag. The ending cash must be summed these two up. The net changes in cash of that year, current year, and the beginning cash of the ending balance of the last year, right? And then we have the ending cash balance. So differences. Now the differences are from cash. Now we need to double check how to calculate now the current year balance, right? The current year balance. Then this minus current year balance must be 0, because now the company, the balance out between total asset and liability. So we got this, the difference from the cash on the balance sheet is 0. That means this ending cash balance is right amount produced on the cash flow statement. Okay. Now, once we create this long-term planning for the ventures, now it's the time to calculate a venture stock valuation by FCFE model. We'll continue to the next video clips. Guys, bye-bye.